If you're trying to build a portfolio that's actually worth something by 2030, then you need to listen up to what I say next. The single biggest mistake you can make is just randomly picking stocks. That's because it's vital that you first pinpoint the right sectors and industries. That's because even the best looking stock in the wrong sectors will languish in the years ahead, whereas even an average stock in the right sectors could flourish. So today I'll share 4 specific areas of the market poised for serious outperformance. Then I'll share a top pick in each of these industries to put on your radar right now. This is all backed by real data, not just hype. By the way, I'm Steve Reitmeister. I have over 40 years of investing experience. I was formerly editor-in-chief at Zacks.com, and now I'm a partner at WallStreetZen.com, where I help build a quantitative rating system designed to help everyday investors more easily find the best stocks to buy right now. Let's set the stage. Every top sector I discussed today that had to first clear an important hurdle, that being the stringent fundamental process behind our Zen industry rating. We measure up the fundamental progress of over 120 different industries, the markers or groups more likely to outperform. Then we focus on the top 2 groups, which are A and B rated industries. We're not starting with a theory and working backwards, hoping it points to the right industries. Rather, we are starting with proven data and building the case from there. Here are the 4 industries we're covering today: AI infrastructure, electronic components, drug manufacturers, and medical distribution. Then I'm going to show you exactly how to evaluate every stock we talk about before you consider investing. If you're enjoying videos like this, then drop a like right now, as it tells me to make more like this in the future. Let's get into starting with our first group, which is AI infrastructure. Everyone is talking about AI stocks right now, and look, the excitement is justified. This is truly a generational shift in how software gets built, how businesses operate, and how research gets done. We're not here to argue against AI. We're here to argue against the way most people are investing in the group now with some severely overpriced stocks with low odds of future outperformance. Of course, I'm talking about the headline names like the Mag 7, the platform companies, and the pure play AI software stocks. These stocks are priced to perfection, and maybe even some more ridiculous than that. Think about it like a football point spread. You know the favorite team is going to win, but are they going to win by 100 points? Well, of course not. And that's precisely how you should look at a PE over 100. That's the bet you're making when you buy into frothy AI valuations. And historically, that bet doesn't really pay off. Just remember the popping of the dot-com bubble over 20 years ago, a painful lesson indeed. So how do you participate in the AI revolution without loading up on the same overstretched names? Well, you go back to a tried and true investing lesson. Think about the 1849 California gold rush. So many people headed west hoping to strike it rich, but very few miners actually made their fortune. The real money was made by the businesses that sold services to the miners. We're talking about lodging, food, tools, supplies. Yes, the service providers won. And because of the gold rush, we often call these kind of companies the picks and shovels plays. That's the AI infrastructure angle, not the software companies writing the new algorithms, the companies building the physical foundation that makes AI possible in the first place, like data centers, networking hardware, power management systems, cooling infrastructure, and high-speed components. All of it has to be built and all of it has to be maintained regardless of which AI platform wears the software arms race. The relevant groups, as tracked by the Zen industry rings, are specialty industrial machinery, which is A-rated, as well as the B-rated communications equipment industry. These are companies supplying power infrastructure, thermal management systems, data center build-out, and high-speed networking hardware. My top pick in the space is Flowserve Corporation, the symbol of FLS. This is one of the greatest examples of modern-day selling picks and shovels plays. They make industrial pumps and flow control systems used in energy, water, and industrial infrastructure. So what the heck does this have to do with AI? Well, these pumps are used in liquid immersion cooling systems for AI data centers. As the world continues to ramp up the building of data centers, they will also need more Flowserve pump. It's that simple. Flowserve has received an A rating overall from our Zen Ratings quant model. The strong buy rating comes from being in the top 5% across 115 different fundamental factors that point to share price outperformance. Flowserve also gets a strong B rating for value. This comes after reviewing 21 different value factors, making it very attractive at this time. Also interesting note the B rating for safety. That is especially important these days given increased market volatility. You probably heard whispers about the AI bubble, given that over 90% of AI investments have proved to have negative ROI. You don't need to worry as much about flow serve as their products are widely distributed across many other industries, not just for AI. In short, they are potentially a true beneficiary of the AI boom, but remain protected against any potential headwinds for the industry. Now, let's turn our attention to what Wall Street has to say, as there are 7 analysts who have showered Flowserve with buy or strong buy recommendations. Back to the value conversation from earlier, one of the industry top analysts, which is Andy Koppelitz of Citigroup, he has a fair value price target, which suggests over 30% upside potential in the year ahead, and lots more appreciation over the long haul. Since I looked at 2 industries here, I've got another pick from the communication equipment group. I'm talking about Extreme Networks with the symbol of EXTR. AI creates massive data traffic, which is great news for this company because they're selling enterprise network equipment and software. Its switches and routers are non-negotiable items for the surging crop of data centers. Now, our Zen Ratings gives an elite A grade overall, placing in the top 5% of companies among the 4,600 different companies we track. Value, financials, and sentiment are the standout categories here, each earning a solid B rating. The company is clearly rebounding after a difficult 2024. Its growth is improving across revenue, earnings, and cash flow. However, momentum only scores a C, with the stock down nearly 15% over the past 3 months. But that could be part of what makes this opportunity so compelling right now. As the market sells off, the Zen rating suggests the stock may have reached a much more attractive entry point. And Wall Street sees the same potential as well. All 3 covering analysts rate the stock either buy or strong buy, with an average price target that implies 65% upside from current levels in the year ahead. One of the most notable calls comes from Mike Genovese at Rosenblatt. He scores in the top 1% of all analysts for his stock picking prowess. His target price implies 75% upside potential from today. Now let's move on to the next area of the market to consider holding in your portfolio through 2030. This is another picks and shovels play in the thriving electronic components industry. The industry overlaps with our AI infrastructure theme and then goes well beyond it. Electronic Components has a Zen industry rating of A, which has been the right call as the group has returned over 60% the past year, and all signs point to more good times ahead. The main reason we're highlighting it today separately from AI infrastructure is because of what it represents strategically. In this industry, they produce electronic components, capacitors, circuit boards, connectors, sensors. These are the center of every major growth theme happening right now. AI needs them. Electric vehicles need them, medical devices need them, and renewable energy infrastructure needs them as well. If you want to design one sector that gave you broad exposure to multiple secular growth trends all at once, this would be your top pick. There are 45 stocks in this industry, which means you have a lot of good options to choose from. The Zen Ratings is our best friend to find the winning needle in that haystack. After reviewing the Zen Ratings data, I found a clear winner in the electronic components industry in Alient with a symbol of ALNT. The company is not just A-rated overall, it's actually in the top 1% of all stocks based on the strength of their fundamentals. On top of that, Alient also scores A for growth. This means it's consistently growing, not just based upon earnings, but we're also talking about revenue, cash flow, EBITDA, and profit margins. Surprisingly, it is also an A for safety. I say surprisingly because growth and safety are usually at opposite ends of the spectrum. That's truly special when a stock is strong in both categories. One potential risk is valuation because the stock has more than tripled in the past year, which may indicate it's becoming overvalued. The good news here is that the Zen Ratings model still gives Alient a B for value, putting the top 20% all stocks. Remember that our model reviews 21 different measures of value, so we are in very good shape on that value front. Before we move on to that next high-growth industry, be sure to hit the subscribe button and the notification bell so you don't miss our next batch of high-conviction stocks. Let's move on to another compelling industry, and that's drug manufacturers. The category is technically called Drug Manufacturers General on WallStreetZen.com, and I want to be very precise about what that means here because the framing matters a lot. It's easy to confuse this industry with biotech. However, right now, the biotech industry is rated F. That doesn't mean every biotech company is a bad investment, but it most certainly means that as an industry, the odds are not in your favor right now. That's a tough starting point if given our goal of creating a portfolio of the best stocks going into 2030. Drug manufacturers, general industry is a completely different conversation. This industry is rated A, and that shows up in the very solid returns for the group this past year. These are established, cash-generating companies and central to modern healthcare. They are not speculative bets. We are talking about reliable growth in financials, many in the blue chip camp. The macro case is straightforward given the aging of the population in many large developed markets. This bakes in consistent growth for drug companies over a long-term time horizon. Plus, pharma demand is greatly expanding in emerging markets as well. And the COVID era made it abundantly clear to governments around the world that domestic pharmaceutical manufacturing capacity is a strategic priority, not just a commercial one. Supply chain reshoring in pharma is a real funded policy-driven tailwind for the group. Now, when you're researching individual names here, focus on the Zen ratings component grades for safety and financials, as because avoiding landmines matters as much as finding winners in this arena. You want companies with strong balance sheets, durable margins, and earnings consistency. Now, large cap generics manufacturers and branded drug producers with deep pipelines and companies with significant export revenue are all worth putting on your research list. All in all, there are 18 drug manufacturers in this industry, but here's the one stock I think could be a strong asset looking out the next several years. It's Bristol Myers Squibb with a symbol of BMY. They manufacture prescription pharmaceuticals and biologics in several therapeutic areas, including cancer, HIV/AIDS, cardiovascular disease, diabetes, hepatitis, rheumatoid arthritis, and psychiatric disorders. The company has exactly the kind of Zen ratings profile I described as ideal just a few moments ago. It carries an overall rating of A based upon all 115 factors, plus an A for safety and a B for financials. That makes it my top pick in this group. This is clearly not a gamble on which company might discover the next breakthrough drug. Instead, this is a well-established pharmaceutical giant with a long track record of earnings growth and a strong balance sheet. On top of that, the stock also earns an A in value, meaning the shares appear very attractively priced at current levels. Wall Street definitely agrees with a strong slate of strong buy recommendations. That includes David Amsellem of Piper Sandler, who ranks in the top 6% of analysts we track based upon his stock picking performance. He sees 25% upside for shares in the coming year. But with a large pipeline of new drugs on the horizon, this could easily double or more as we look out to 2030. Not bad for one of our more conservative picks. Before I keep going, I wanted to share a few more high potential stocks our Zen rating system is watching closely right now. If you want the full list, then download our free report, 3 Stocks to Double This Year, by clicking the link in the description below or scanning the QR code on the screen. On to our last industry, which is medical distribution. This seems like a boring infrastructure play that too many people are overlooking, which is exactly why I like it so much. The logic here is the same as the AI infrastructure. When healthcare scales, someone has to move the product from manufacturer to hospital, from warehouse to pharmacy, from distributor to clinic. That's medical distribution. It's not glamorous, it doesn't make headlines, but it's A-rated with over 40% return over the past year. And the structural demand for it grows in direct proportion to everything happening in the drug manufacturing sector we just discussed. The macro case here is durable in a way that most sectors can't match. You don't need to predict which drug wins. You don't need to pick the right therapy or right disease category. You just need healthcare to keep scaling. And given aging of demographics and expanding access and rising global health spending, that's about as reliable a backdrop as you're going to find for a 5-year investment time horizon. This is a sector where you don't need to predict which drug wins. You just need the trucks to keep on rolling, right? And that brings us to our top pick in the group, which is Cardinal Health with a symbol of CAH. Cardinal operates one of the largest healthcare distribution networks in the United States. The company supplies pharmaceuticals and medical products to about 75% of the hospitals across the country. Yes, 75%. That's an enormous footprint within the American healthcare system. The company currently holds an overall Zen rating of B, which is a firm buy recommendation. The component grades are also very strong, where they score a B for momentum, safety, and sentiment. Sentiment is what the smart money thinks about the stock. This top 20% showing for these key areas suggests the company could continue building on its recent excellent performance. The best part of the story is the A rating for growth. This indicates the company is consistently growing on both the top and bottom line, as well as strength in cash flow, EBITDA, and profit margins as well. Wall Street definitely agrees with nearly 90% of the analysts covering the stock, giving a strong buy or buy recommendation. Some of these strong buy ratings come from some of the best stock pickers on the street. We're talking about Kevin Caliendo of UBS, ranked in the top 18% of all analysts for his stock picking performance. Even better is Erin Wright of Morgan Stanley, pounding the table in Cardinal, and she is in the top 5% of all analysts. Today, I shared what the best industries to buy now. Then we narrowed into the best stock pick in each group. I strongly believe this is a great game plan to consider for your portfolio through 2030. But if you prefer different industries or have other stocks in mind, I'll show you exactly how to use the tools on WallStreetZen.com to improve your researching process. Start at the industry rank page. Scan the QR code to go there directly now. Before you look at any single stock, check the industry rating. An A or B rated industry is your strongest starting point. These are the groups where the average stock has historically shown the greatest tendency to outperform. That's because top rated industries means the fundamentals are broadly healthy across the group and the odds are tilted strongly in your favor before you even pick an individual stock. A lower rated industry means you're swimming against the current. Possible to find a winner, but it's also more likely to drown. Think of it this way. The more A-rated stocks you own in A-rated industries, the more you're stacking the odds in your favor at every level of the decision. Once you're inside an industry, click through to see the constituent stocks sorted by the Zen rating, starting with the A's and then the B-rated names. The system has analyzed 115 factors across thousands of stocks going back to 2003. When it rates a stock C, D, or F, that's the model telling you the probabilities are most certainly not in your favor. That doesn't mean those stocks can never go up. It means you're taking on more risk for less statistical reward. From there, layer in component grades that fits the specific sector's risk profile. But in general, the three most important are the growth component grades, financials, and value. And there's one more tool worth knowing about here. On any individual stock's quote page, you'll find a rank in industry feature that shows you exactly where the stock sits relative to its peers. So if you're researching a name and it looks interesting, but its overall Zen rating is giving you pause, check the industry section. You might find the industry itself is highly rated, but you've landed on, say, like the 14th best stock out of 15. That's your signal to keep looking because the better peer in the group is right there for the taking. That's the process. It's repeatable, it's data-driven, and it's the same framework whether you're researching these four sectors or any others. If you want to explore some great examples of top-of-the-line stocks in their respective industries, then be sure to check out this next video.